Welcome to PNJ training. In this session, we are looking at 8 hidden traps in CECL, the current expected credit loss standard. These are the mistakes that practitioners carry over from the old incurred loss model, and understanding them is how you move beyond that legacy mindset. By the end of this video, you will know where each trap sits in the accounting life cycle and exactly how to avoid it. Before we walk through the individual mistakes, it helps to know why they happen in the first place. There are 3 root causes behind virtually every CECL error. The first is incurred loss hangovers, habits built under the old model that do not translate to CECL. The second is incomplete documentation, particularly around qualitative adjustments. And the third is static period-end processes, treating CECL as an annual exercise rather than a continuous one. Keep these 3 patterns in mind as we go through each trap. Here is how the 8 traps map across the accounting life cycle. Traps 1 and 2 occur at origination, the moment an asset is first recorded. Traps 3 and 4 relate to measurement, how the allowance is calculated and updated. And traps 5 through 8 cover reporting and resolution, everything from acquired assets and off-balance sheet exposures to write-off timing and disclosure errors. We will work through each stage in order. Trap 1 is called waiting for trouble. Under the incurred loss model, staff were trained to record an allowance only when an account became overdue or showed signs of credit problems. Under CECL, that approach is wrong. The rule is simple. Origination equals a day 1 allowance. The moment a receivable or loan is recorded, even a current, perfectly performing one, the allowance calculation must run. There is no waiting period. Every in-scope financial asset requires an allowance from the very first day it appears on the books. Trap 2 involves day 1 profit and loss charges for purchased credit deteriorated assets, or PCD assets. When teams acquire a financial asset with evidence of prior credit deterioration, they sometimes reach for the standard originated asset journal entry. That is a mistake. PCD assets use the gross-up approach. The initial allowance is credited against the asset cost, not run through the income statement. So before recording any entry on an acquired asset, confirm whether PCD classification applies. The classification determines the entire treatment. Trap 3 is relying only on the past. Some teams apply prior period loss rates unchanged, treating the CECL model as a simple roll forward of historical averages. But CECL requires 3 inputs working together: historical data, current conditions, and a reasonable and supportable forecast. Historical rates alone satisfy only one of those 3 requirements. Even a straightforward, well-documented qualitative factor adjustment satisfies the forward-looking requirement. Applying historical rates with no adjustments at all does not comply with the standard. Trap 4 is generic qualitative factors, also called Q factors. These are often applied as a round number percentage add-on with no written rationale. A statement like economic conditions are uncertain, so we added 0.5% will not survive an audit. A defensible Q factor must have 4 documented elements: the category and direction, whether the factor increases or decreases the rate, the specific magnitude as a percentage, data-backed reasoning that explains why this condition affects this pool, and the specific pool impact. Vague round numbers are a red flag. Rigorous defense is required. Trap 5 is the year-end only myth. Some teams treat CECL as an annual exercise, using interim periods as rollovers of the December calculation. That is not compliant. CECL requires a full recalculation at every reporting date. Credit conditions shift between quarters. Portfolio composition changes. Qualitative factors that applied in December may not apply in March. Each quarter-end or period-end is a fresh estimate, a continuous assessment cycle, not a carry-forward from the prior period. Trap 6 is the unseen exposures. Think of it as an iceberg. Most teams focus on the visible part, receivables and loans sitting on the balance sheet. But the portion below the waterline, unfunded commitments, guarantees, and letters of credit, also requires a CECL assessment. If an off-balance sheet exposure is not unconditionally cancelable, it requires recognition of a liability. This review belongs on the period-end checklist as a standard step, not an afterthought discovered during audit. Trap 7 is accumulating zombie accounts. Teams sometimes delay writing off overdue accounts hoping for eventual payment. The result is that the gross receivable balance stays inflated, and the allowance accumulates without a corresponding reduction, misrepresenting the portfolio. The fix is a clear write-off policy with time-based triggers. For example, accounts more than 180 days past due with no active payment plan should be written off. It is also important to remember that write-offs carry zero profit and loss impact. The loss was already recognized when the allowance was established. Trap 8 is over-disclosing vintages. Some staff apply the same disclosure checklist to every asset class without distinguishing which assets require vintage disclosures. The vintage disclosure, amortized cost by origination year and credit quality, is required for financing receivables and leases. It is not required for trade receivables measured using the loss rate method. Applying it where it does not belong creates unnecessary work and can produce misleading disclosures. Stop using generic checklists. Know your asset class before applying disclosure requirements. That brings us to the CECL defense framework, 3 practical actions that prevent all 8 traps. First, embed day 1 and purchased credit deteriorated recognition directly into your origination and acquisition software, so the right treatment is automatic. Second, require 4-pillar documentation for every qualitative factor and every forward-looking forecast category, direction, magnitude, and reasoning. Third, include off-balance sheet items and strict write-off triggers in your period-end checklist so nothing falls through the cracks. Apply these 3 disciplines consistently, and CECL compliance becomes a process, not a scramble. Thanks for watching. If you found this useful, subscribe to PNJ training for more videos like this. Thank you for watching. Subscribe for more training from PNJ Group.